Okay, third question. I would like to know about the tax deduction scheme on loan interest because my dad just bought a property in Sydney recently. How is the process? Is it the same like we do for claiming GST?
The answer to that is no, it's not the same as GST, it's completely separate. Um, Interest on loans is effectively a deduction against your rental income. So you just claim it as a normal deduction you would in your tax return, same as work-related expenses, motor vehicle expenses, those sorts of things. It's just claimed in a different section of the tax return. One of the things that people do with negatively properties is rather than getting the big refund at the end of the year, they do what's called a withholding variation on their wage. That means that the government will tell your payroll office to withhold a lower amount of tax each week, gives you more money in your pocket from a day-to-day point of view in order to fund the negative gearing on the property. So it's pretty straightforward.
Sorry.
That's all right.
Continue.
No, that's about it.
Okay, beautiful. Fourth question. I'm in the first year of my property investment journey and have a couple of questions. One, how are you able to claim mortgage insurance? Two, what sort of improvements can you claim on your investment property? I.e., can you claim the purchase of new carpet or a new paint job?
First on mortgage insurance is pretty straightforward. Any cost of borrowing money to buy an asset, the government gives a specific deduction for that over a 5-year period. They basically say that rather than claiming it all up front, when your total amounts for that year are over $300, you write them off over 5 years equally. Yeah. So it's not an immediate deduction, but it is a deduction nonetheless. Mortgage insurance can be quite high depending on what LVR you're borrowing at. If you're borrowing at 95%, your mortgage insurance can be upwards of $5,000-$10,000, sometimes even more. So the higher the amount, that's the reason the government won't give you an immediate deduction. It seemed to be a cost of earning money over time, so they allocate it on that basis. The other one, which was what was
improvements?
Improvements. Everything's different in this. It's a very grey area as to what you can claim. The general rule of thumb with it is a repair is just bring it back to its original state. So if you've got a damaged wall and you plaster it up and you repaint it, generally that will be a deductible expense immediately because it's just repairing something to its original state. Where the repair is improving it beyond its original state, that's generally where the tax office will deem it to be a capital expense, and it will be written off over time, either as a property improvement capital expense, 2.5%, or it'll be a specific amount over time. So if you're improving it, things like doing a complete paint job of a house, they'll deem that you're actually improving the property beyond its original state. So I'll say that's capital. Carpet depends. If you can prove you're just replacing damaged carpet, then yes, it's claimable expense. If you're putting in better carpet than what there was there before, then definitely it's a capital expense and it'll be added to your cost base or depreciated. That's one of those things that you will, at the end of each year, you go through your accountant at that time and say, look, these are the things I did to the property, these are the things that I just thought were repairs, these are things that maybe could consider, and at the time you'll assess how far you're willing to push the envelope as to what you want to claim.
Okay. Question 5. I would like to know if I purchase a property overseas, for example New Zealand, then can I use negative gearing and claim losses against my Australian income? Currently I work in Sydney. And then again, as New Zealand does not have capital gains tax, but Australia does, will I have to pay capital gains on earnings made if I leave the money in a New Zealand bank account?
If you are a tax resident of Australia, so you live and you work in Australia, you don't have to be a permanent resident to be a tax resident of Australia.
Yep.
If you are a tax resident of Australia, you are taxed on all sources of income no matter where they're from. So if you've got rental income from overseas, then you will be assessed on it over here. We have with New Zealand what's called a double taxation treaty, or a double taxation agreement, which means that any tax you pay in New Zealand, you will get a offset for that over here. So you're not going to be taxed on the same amount of income twice.
Yep.
With regards to the capital gains tax issue, that's depends on the situation. Leaving the money over there effectively doesn't help you at all. You are deemed to have derived the income, so you will be taxed on it. Where the money's gone doesn't really matter. As for getting negative gearing from a property over there and claiming it over here, my understanding is that you would have to look into that because it is deemed foreign source income, which does have some different rules to it. But I would certainly see your accountant to determine that one.
Okay. And lucky last question. I've been negative gearing my investment property for 3 years now. I've heard a rumour that after 5 to 6 years, if I move in and reside in the property, I don't have to pay capital gains tax. Can you please confirm?
I can confirm that that's incorrect. What you're referring to is what's called the 6-year absentee rule. In order for the 6-year absentee rule to apply, you have to have lived in the property first.
Yes.
What it was originally set up for is a situation where you live in a house, you've been your main residence since the day you bought it, work for whatever reason, say we're going to send you to live in Perth for a couple of years in order to work over there. You're just going to be renting while you're over there, you're not going to buy a property. After the 2 or 3 years, you come back, move back into your house and continue your life. This period of time is called, you're just absent from the house. You are entitled to rent the property out. You don't have to leave it vacant over that period of time, but you do have to be back in the property within the 6-year period of time. One other thing to note with this is you cannot have another main residence during that period of time. So if you move somewhere and buy a new house and start living in that, tax office will deem that at that point in time that new property became your main residence. The one that you were living in previously will cease to be the main residence. The 6-year rule becomes irrelevant. If you bought a property purely as an investment and then you move into it to live, one of the things I would suggest you do is go see a real estate agent, get a value on the property at that date. Because if you come to sell the property down the line, you won't pay tax on the whole period of time. You'll only pay the tax on the period of time up until which it was rented out. Once you move in, it becomes your main residence, you're not taxed on it.
Okay. So there you go. That's the end of our Q&A session. Thank you for answering those questions. And yeah, my next Q&A session will be in the coming months, and I'll be having my favourite mortgage broker come and join us to answer questions about home loans and the like. So until then, thank you.